General Dynamics is currently trading very near their 52-week low, where they are down by 4.6% over the past year. So should you start buying into this company at their current trading price? Well, to figure this out, we'll jump to my stock valuation spreadsheet, where we'll plug in the company's ticker and all the metrics will show up automatically. Now, to understand how well the company was performing in the past and to speculate how they will perform in the future, we will jump to the 9-pillar analysis, where as you can see they get a rating of 8 out of 9, with the only pillar sitting in the red being the 5-year profit margin. And actually, when I zoom into pillar 6, you can see that it has been decreasing from 2020 from 8.35% to only 7.93%, which it is sitting at currently. Now, what you have to understand is that it has been quite common with defense stocks to decrease their profit margin over the past 5 years. So I'm not too worried about this. And actually, when I scroll down, you can see that the return on invested capital has been quite stable. So I don't actually really mind at all. The profit margin currently sitting at only 7.93. Now, when I move back to the 9 pillars, something I always say is that a company's stock price growth is mainly based on their financial growth. So when we have a look at the company's 5-year revenue CAGR, you can see that it is sitting at only 4.80%. Free cash flow is sitting at 3.85%, and net income is sitting at only 3.76%. So the company has quite low financial growth, but the great thing about buying undervalued companies is that their stock price growth will outpace their financial growth as they become more fairly valued. So let's figure out if General Dynamics is actually trading undervalued. The easiest way to speculate that a company is undervalued is to have a look at their 5-year PE ratio and their 5-year price to free cash flow. The 5-year PE ratio is sitting at only 17.22, which means that investors are paying $17 for every single dollar of General Dynamics earnings. So when I zoom into pillar 1, you can see that currently the PE ratio is actually sitting a little higher at 18.85, but that is still in the range we would like it to be in, as the average stock PE ratio is 22.5. So when a company's PE ratio is lower than this number, which is the case with General Dynamics, it hints that the company might be undervalued compared to the net income they bring in. And when I zoom into pillar 2, we can actually have a look at a similar metric, that is the price to free cash flow. Instead of net income, we have a look at the free cash flow of the company, and this is sitting at only 18.64, again lower than the average stock price to free cash flow. So based on these two pillars, we can somewhat tell that General Dynamics might be undervalued. But to really figure this out, we have to calculate their intrinsic value using our 4 valuation models. So when I jump to the Grams formula, I will take the 5-year EPS, the base PE, the growth rate multiplier, the average yield on AAA corporation bonds, and the current yield on AAA corporation bonds. But to move forward with the valuation, we have to predict the 5-year earnings growth estimate. And to do this, I will predict the high at 12%. I will go for the medium at 9%, and low I will predict at 7%. And averaging this out with the analyst expectations, we will get a 5-year earnings growth estimate of 11.40% into the next 5 years. And when we plug all these values into the Grams formula, we will get an intrinsic value of $279.28, which is actually 9% higher than the current trading price. Now, for the second valuation model, we will jump to the discounted cash flow model, where we will plug in the free cash flow of the company over the past 5 years and calculate a low average growth rate of 3.85%. Now, into the future, into the next 10 years plus, I will calculate the high growth at 8%, medium at 6%, and low at 3%. I will average these out and get a calculated growth rate of 5.7% into the future. I'll then use this to calculate the future free cash flow, and plugging in a discount rate at 7.66%, I will convert that free cash flow into its present value. I will then sum all of it up, add cash and cash equivalents, and subtract their total debt and get their equity value, which I will divide by the shares outstanding and get an intrinsic value of $254.44, which is a little lower than the current trading price. Now, before we get to calculating the intrinsic value through our multiples valuation and the dividend discount model, let's have a look at some of the remaining metrics in the 9-pillar analysis. Something I always like to look at is the company's long-term liabilities to figure out if they are not too vulnerable to harsh financial situations. So as you can see, the long-term liabilities over the 5-year free cash flow negative dividends for General Dynamics is sitting at only 1.97, which means that with the free cash flow they are currently generating and the dividends they are currently paying out, they can pay off all their debt in about 10 years, which is completely fine. Now, something I also want to point out is the company's 5-year dividend CAGR sitting quite high at 6.60%. So when I zoom into Pillar 8, you can see that this is actually higher than the average stock year-over-year dividend growth. And with the company's dividend yield of 2.21%, again higher than the average stock dividend yield, this company is a great company for dividend investors. As you can see, their dividend grew from $4.40 in 2020 to $5.68 in 2024. And their 5-year free cash flow payout ratio is also sitting nice and low at 41.27%. And if I scroll down, you can see that it did increase slightly in 2024, but that is because of their drop in free cash flow, which I do believe is just a one-time thing, as you can see, it has been rising very steadily for most of the past 5 years. Now, if you have made it so far into the video, I just want to let you know that I have started teaching investing in online one-on-one sessions. So if you have just started investing and have questions or simply want to learn all about stocks and the stock market, you can sign up by going to the link in the description. We are currently running a 20% discount. But now that we have gone through the 9-pillar analysis and everything is looking nice and sweet, let's finish calculating the company's intrinsic value. So jumping to the multiples valuation, I will compare General Dynamics to one of its competitors, that is Lockheed Martin. I will take this company's current stock price, divide by their earnings per share and get their P/E ratio, which I will multiply by the EPS of General Dynamics and get an intrinsic value of $272.94. And for the final valuation model, we will jump to the dividend discount model, where I will plug in the dividend growth over the past 5 years, and into the future I will predict the high growth at 8%, medium I will go with 6, and low I will plug in at 3, and this will give me a projected growth rate of 5.67% and give me an intrinsic value of $300. And finally, moving to the ultimate valuation, we will average out the 4 valuation models. I will switch the alternative one to the normal one, and we will get an intrinsic value of $276.80, which is 8.5% higher than the current trading price. And so with a margin of safety of, let's go with 10%, we would get an acceptable buy price at $249.12, which the company might actually reach very soon with their falling stock price. And with that, if you'd like to download these fully automatic stock valuation spreadsheets, you can always do so at the link in the description. And if you enjoyed the video, make sure to leave a like and subscribe, as it really helps me out.